Chapter 3's third objective is to explain why we need to make adjusting entries. Okay? Back in objective number 2, we talked about the time period concept, whereby we're required to adjust the accounts at the end of the period. We adjust these accounts to recognize the fact that time has elapsed and the balances may have changed due to time or usage. Adjusting entries, what are these? These are prepared at the end of the accounting period. What we're doing is assigning revenues to the period when they've been earned and expenses to the period when they've been incurred. It also updates asset and liability accounts, because what we're trying to properly measure is revenue and expenses being equal to what? Net income. Okay? And we're adjusting the assets and liabilities to properly reflect the balances on the balance sheet. So adjusting entries in fact affect two financial statements: revenues and expenses on the income statement and assets and liabilities on the balance sheet. Adjusting entry rules. Number 1, it never, ever, 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 ever involves cash. Number 1 rule. You will never have an adjusting entry to adjust cash. Number 2, it either increases a revenue or an adjusting entry increases an expense. So all adjusting entries will affect either a revenue or an expense. That's number 2. And the third rule is that accrued means that we need to record the amount. What do we mean by record the amount? It's got to be journalized, number 1. It's got to be updated on the ledger account. So accrued means recording the transaction, journalizing it, and posting the adjusting entries.